Today, I am going back to our regular programming with a conversation recorded right at the very beginning of the coronavirus crisis with my guest speaker, Spencer Levy, who is chairman of America's Research and senior economic advisor for CBRE, who are, as you know, the largest commercial real estate firm in the world. Adam Gower here, and welcome to the Real Estate Crowdfunding Show, syndication in the digital age at gowercrowd.com. Now, when I spoke to Spencer, we'd all just been sent home to work, and our conversation, though tinged with what was going on, had not become quite immersed yet in the depths of the national lockdowns that we are today enduring. So while our conversation was not specifically focused on the impact of coronavirus on commercial real estate, what you're going to hear today is an analysis of cap rates, what they are, why they are misunderstood, and how they impact commercial real estate from one of the foremost analytical minds in the country that will be of significant value to you as you start to navigate through the current crisis. Spencer's perspective challenges the usual understanding of cap rates, and his insights will take you deeper into the metric than you've likely ever been before. Perfect, in fact, for seeing the world as it has evolved and continues to evolve through this crisis and through a different tinted lens. I'll put some links to Spencer, the cap rate survey that he and CBRE produces, on the podcast page for today's episode. Plus, you'll also find links to the deeply discounted investor acquisition system. Actually, it's over 80% off our flagship program that we'll be offering until the shelter-in-place orders are lifted. And then after that, we'll revert back to the usual pricing. So take advantage of that now while you've got the time to learn something new, right? It's well worth it. Actually, there are masses of resources for you overall at Gower Crowd. Most of them are free. You can find out how to upgrade your home office, a guide for crisis communications, a whole series of podcasts focus on coronavirus and how to thrive, not just survive, all there at gowercrowd.com. Do go ahead and feel free to explore all of that. All right, let's get to Spencer Levy, chairman of America's Research and senior economic advisor for CBRE, and a deep dive into cap rates, how they work, why they are misunderstood, and how you can use them to navigate the world of commercial real estate as we battle with the current chaos in the industry. Here we go. Spencer, thank you so much for being on my show. It's really fabulous to see you, and I'm very flattered that you would take my call because you put out this incredible cap rate survey, right? And before we start to talk about that, I'm just going to recount one little story that I do tell once in a while because I'm going to ask you some very basic questions. When I first started teaching real estate investment and finance to students, I got up and I gave of my best. I gave them a full hour of detailed background, and this is real estate investments and finance. And I asked, anyone got any questions? And the first hand goes up at the front. The first person said, yes, Dr. Gower, what's a mortgage? And I just thought, I see. We have to start kind of at the beginning. So in your case, if you don't mind, can we start at the very, very end, actually, of your report and the definitions section that you kindly put in there? What is a cap rate?
Well, Adam, and it's funny you mentioned that because cap rates are a misunderstood item. A lot of people think that a cap rate is the same thing as a yield. And so what a yield is when you have a return on an investment. And a return on an investment, assume you put in $10, you get $1 a year. That would be the equivalent of a 10% yield. And a lot of people believe that's what a cap rate is. It's the same thing as yield. Well, it's not. While it might be the same thing as your initial yield going in, it actually is the combination of two things. Number one, it is the cost of capital. Number two, it is your growth expectations. You take two of those things together, and then you come up with a cap rate. And so a cap rate is applicable to a stabilized asset. a cap rate really isn't applicable to a non-stabilized asset. So you take that same example I gave you a moment ago. If you have a $10 investment, you get a $1 a year yield. That is a 10% yield. But you take that same investment and you have no yield. What is your cap rate? It's infinite. You can't even calculate it. So when you're dealing with stabilized assets, your cap rate might be very similar to your yield. But when you're dealing with non-stabilized assets, you really can't use a cap rate. You have to use price per square foot, or what most people will use is a stabilized cap rate. What will the cap rate be once you've stabilized the asset after you've used your acquisition costs and capital costs?
Fascinating. Okay, that's a really interesting take. So how do you calculate the cap rate? What is the calculation?
Well, the cap rate, it can be calculated on either a pro forma forward basis or looking back basis. And depending upon who you are, you have to calculate it one of those two ways. I would say that most people, when they're marketing an asset, calculate a cap rate on the forward, which is based upon the income you expect to receive in the next year. Though some people are required to look backwards if you're looking to appraise it or you're a lender and you're looking for other metrics of stabilized cap rate. Look at the forward and the backwards cap rate. So on a forward cap rate basis, let's assume for the moment that you have a stabilized asset that generates $1 a year of net operating income. Now, net operating income, not to make this overly complicated, is basically what's left after you've paid for expenses in the building. You've gotten your rent, you pay your expenses in the building, you've got your net operating income roughly. And that then you need to put through your capital structure and figure out what your free cash flow might be. But for purposes of cap rate, you don't do it on free cash flow, you do it on net operating income, which is before your capital structure. So what your cap rate would be is the percentage of yield based upon the amount of money you've invested in the building divided by your NOI, or rather the reverse of that, your NOI divided by the amount you've invested in the building. So in that building, if you pay $10 and you're getting $1 of NOI, you have a 10 cap. If you take that same building and you get 50 cents a year, you get a 5 cap. And the reason is that a cap rate is the inverse of a multiple. Many people call a cap rate an inverse multiple, at least I do, because that's what it is. So if you hear a 20 times multiple, it's the equivalent of a 5 cap rate.
Yeah, exactly. So now you've described a couple of characteristics of the cap rate. How is it used? Before we get into your research, I mean, how is it used in the commercial real estate industry?
Well, notwithstanding the fact that our cap rate survey is our CBRE's most popular research piece every year, bar none, because it's a tremendous resource to look across multiple asset types, multiple markets quickly. Now I'm going to go full circle. We use cap rates too much. And why is that? Because they tell you something, but they don't tell you nearly enough. They give you a very good snapshot, but they don't go into the nuances that I've described a moment ago as it relates to things such as what is your expenses you're going to have to spend, your capital expenditures to stabilize your building to get to a stabilized yield. I prefer looking at it on a discounted cash flow analysis, perhaps better than looking at it on a cap rate basis. But nevertheless, it's a very good, quick snapshot of where values are in the market, and you can do it on a relative apples to apples basis across market and across asset types.
Right. Okay, so you talked about discounted cash flow, but I want to kind of just continue on this. How is the cap rate used? So there's two ways that it's used. One is to look at forward looking in terms of value so now you said it's not yield, right? It's not yield, but at the end of the day, you are looking at projecting when your building is going to be stabilized and what kind of returns you're going to get at that time. So that's one way, but it's also used to calculate value, isn't it? In what way is it used for that when you're looking at a property?
Sure. So let's assume that you have a property that is generating $1,000 a year in net operating income. And the property next door, let's say it's an industrial asset, because an industrial asset, they typically have lower cap rates today than many other asset classes because they're so popular. And let's assume that the asset next door traded at a 5 cap. You say, oh, well, I'm going to put a 5% yield on my $1,000, and whatever 1,000 times 20 is, which is $20,000, that must be the value of my building. If my building it generated $10,000 of NOI, it would be a $200,000 building if the building next door is a perfect comp. If it's not a perfect comp, then you adjust the cap rate. Maybe your building isn't as well located. Maybe it needs more CapEx. Maybe your lease of your tenant doesn't run as long. Maybe there are other things. It doesn't have as good of parking. But maybe it's a superior asset. Maybe it's the best industrial building, brand spanking new with perfect credit tenant. They prepaid their 10 years of rent in advance, and they're going to cut you a check. You'd get a lower cap rate.
You might, yes. You might end up living in Brazil as well if you got those kinds of terms, right? I'll take the rent, I'm off. All right, so what impacts? Well, so you've actually answered my next question, Paul. What are the key impactors of cap rates? What impacts it?
Well, let me back up for a moment if I could, because there really are only 2 risks in the real estate business. One is traditional real estate risk, and the second is what I call operational risk. Now, real estate risk is when you have a tenant, you've underwritten the tenant. Are they going to stay for their full term, meaning is their credit good? And will they then renew in your building afterwards, and what that's going to cost you? That is traditional real estate risk. You know what operational risk is? Everything else that it takes to run your property. And that operational risk, what's been happening today is operational risk has been going up. And why is operational risk going up? As I give an uppercut to you metaphorically out here on the phone. It's been going up because in certain asset types, leases have gotten shorter. In certain asset types, operations in the building have gotten more complicated, particularly in the office space. When you see the rise of co-working space, those leases they could be 1 month long versus being a traditional 5 or 10 year lease in the space. So that's one risk. The second is people now need to spend more money on common areas to quote unquote activate the building. So traditionally common areas might be a expense of, say, just use rough math, 10% of the cost of running a building, just to use rough math. Now it might be 15% if you need to have better common areas with better amenities in order to attract and retain the best tenants. And so this operational risk is also going up because many people are now creeping into what I call alternative asset classes. What does it mean to go from a major asset class to an alternative? I'll tell you what it means. If you go from a suburban office building to a medical office building, they may look like to the average person that they're the same on the outside, but they are not. It costs a lot more to operate a medical office building than a regular office building, number one. Number two, the tenant pool is much smaller. It's all doctors and medical type uses, so it's harder to get that tenant, and they're more particular about their needs and things like redundant power and having doorways that are wide if they have stretchers and light surgery. So you would think that the cap rate would then be higher for a medical office building than it would be for a suburban office building. And until about 3 years ago, you would have been right. But now it's not. Now cap rates have equalized because operational risk has gone up so much in the base office, retail, and I might add multifamily asset classes that they are now coming down in some of the alternatives as private equity capital has come into the space, created these terrific operating platforms. And so they now have yields that are very similar, even though they're taking on more operational risks. Yields or cap rates, very similar to the base asset classes.
Fascinating. So in what way has operational risk gone up for multifamily?
Well, people want more. They want a hyper amenitized multifamily experience. I'll give you one tongue-in-cheek funny comment. So one of the hip areas in multifamily now where it's going is co-living. Co-living is essentially smaller units, bare bones within your unit, and everything in the common areas is being provided to you. I call co-living, tongue-in-cheek, senior housing for young people because what they're getting are those types of amenities in their buildings. Now, they're not getting the same level of care as you're getting in a senior housing facility, but they have the pool table, they've got the bar, they've got the food, they got everything, right? But here's the thing about senior housing as distinct from co-living. What really makes it much more expensive to operate senior housing is that there's, number one, a tremendous labor shortage out there, hard to get help. And number two, that labor has gotten very expensive. And so senior housing still has a pretty big cap rate delta, meaning it's much higher than the typical cap rate is for regular multifamily because their operational risk is so high relative to the base asset class.
Right, and that's the same for hotels. So the distinction that you're making is that which is more hands-on, that requires greater management, like senior housing, like hotels. These kinds of assets are basically businesses. So you're running a business as well as operating.
Well, that's right. And one of the key questions that landlords need to confront today is how much do they want to run it like a landlord and how much do they want to run it like a business? And that's a key question, particularly in retail. So what you've seen in retail recently is several high-profile bankruptcies of large retailers. You know who's been bailing out a lot of these retailers? The landlords. They're buying the retailers so they can continue to operate in their malls. And the question is the landlord now the operator, or are they the landlord, or are they both? And in the case of co-working, you're seeing something even more interesting, where in many cases, you're seeing the landlord being the operator or doing it directly or in joint venture. So they're directly giving these short-term leases to the short-term operators or the smaller tenants. And so in that case, there is no lease. It's just the cash flow. And here's the key question. So why wouldn't a landlord do that? Why wouldn't a landlord take more money for a shorter term lease with a small tenant? Makes sense, right? One big exception. You get a lower multiple on that. It means the cap rate is higher. So let's assume that the typical multiple in your building is a 20 times multiple or a 5 cap. Okay, let's assume that, right? If you have $1 of NOI from a traditional lease, they're going to multiply that $1 by 20 to give you the value of your building. Are they going to multiply that $1 from that co-working space by 20 when they value your building? That is the key question, because the market has not yet moved to the point where they're willing to accept $1 of cash that doesn't come from a traditional lease and value it at the same cap rate as operating income.
Right, and you're talking about co-working in this case.
I'm talking about co-working, yes.
So this is very much the WeWork model. We looked at a few leases here locally. It was very, very interesting how it was underwritten. But at the same time, doesn't co-working look more like multifamily in the sense that you have short-term leases, you're still providing the same facility, tenants still come and go. Right? Is there, you don't see a parallel in any way?
Well,
except people aren't living in the building.
It's funny you mention that, because I did an event last year at University of North Carolina, Chapel Hill, and that was the precise argument that one of the professors was making. He said that all real estate is going to become multifamily. And for that very precise reason, everything's shorter term, everything is gig-like. And I didn't fight him from what the tenants want perspective. I'm not going to fight you on that. Where I am going to fight you is on a capital perspective, which is where these cap rates come in. Because the market today still will not value a building giving you the same high multiple with a shorter term lease than with a longer term lease. Now, multifamily is obviously an exception. Why is multifamily an exception? And I say this not to disparage any multifamily tenant, but they are considered to be commodities. The tenants in a retail office building are not, number one. And number two, multifamily has what's known as Fannie and Freddie Mac backing them up, government sponsorship, which gives them deep and liquid capital markets, which simply do not exist in these other spaces. And the existence of that, I think, makes multifamily an exception to the rule of how they get cap rates that are among the lowest in the market because of the deep and liquid markets, deep and liquid debt capital markets.
That's really interesting. So when you talk about multifamily as being a commodity,
so not the asset, the tenants themselves
is a commodity,
are much less unique than are the tenants in an office building or retail, as an example.
Right, which makes them more predictable, right?
Yes.
it makes it easier to predict because it's a commodity, right? So my question would be, how do, and now we're getting into your research and hopscotching over another question I had, but how do cap rates, actually my next question was, how do cap rates vary across different classes, A, B, and C? But let's extract from that actually this question. How do cap rates vary office class A and multifamily class A? If those are the same, doesn't that disprove your theory? And if they are different, in what way are they different?
Well, Professor, let me just, I hate to disabuse you of this notion.
Please do.
But if you take a Class A office asset and a Class A multifamily asset in New York, in San Francisco, in Los Angeles, in Washington, D.C., in major markets, you're going to see a very similar cap rate for Class A office in those major markets as you will for Class A multifamily. Very similar, not exactly the same. There's nuance, but they're similar. Where you're not going to see the same cap rate is if you go to a smaller market. If you go to a smaller market like a Baltimore, like a Cleveland, like a Richmond, Virginia, you're going to see an enormous spread differential between multifamily and office. And that spread differential could be 300-400 basis points, meaning that you could have the best multifamily asset in Baltimore might trade at sub 5 cap, but the best office building in Baltimore might trade at a 7 cap. So that's 200 basis points. And if you go into a market like a Cleveland or even smaller like a Richmond, it might be an 8 cap. It might be a 9 cap on the office buildings, but the multifamily is still only going to be around a 5.5 cap. And so that delta just widens as you get to these smaller markets. So don't think that multifamily and office trade the same just because they do in New York, San Francisco, and Los Angeles.
So why do they then in these major metropolitan areas? What's causing that delta to narrow or disappear?
Well, 2 factors. Number one, as I mentioned before, the reason why multifamily has such low cap rates is largely due to its liquidity. It has tremendous liquidity due to the debt capital markets. But when you go to these major metros, the liquidity of office assets is not the same, but it approaches the level of liquidity of these multifamily assets, number one. Number two, I got bad news for most markets in America. I play a little magic trick. I'm going to play a little magic trick right here with you on the phone here, if I can, Adam. I'm not even sure where you're sitting, but I'm going to guess the Class A rent in your market is $21.50 for office. And why am I guessing that? Because that's the Class A office rent in 90% of the office markets in America. You know where it's not $21.50? In New York, San Francisco, Boston, Washington, D.C. And I go right down the list, the major markets. And then there are some emerging markets that have growth as well, like Austin, Texas, like Denver. I can go down these lists as well. So a cap rate, you have to remember, what did I say what a cap rate was? It is the combination of the cost of capital and growth expectations. And these major markets have actual growth expectations on Class A rent that the smaller markets typically do not.
Yeah, that's really interesting. So let me just get around that. It's a combination of, you didn't use the word yield, but of what did you say, of yield?
I said the
growth?
cost of capital. The cost of capital really is, what is the
growth.
minimum return you need on your capital plus the growth rate, right? And so the expected growth rate of NOI. If you have no NOI, let's assume your NOI stays flat for the next 20 years. You have no growth rate, and you pay a 10 cap for the building. And assuming you have no CapEx during that whole hold period, you have a 10% cap rate and a 10% yield the entire period of a hold, right? But if you, like most buildings, you have CapEx, you have other expenses, and you have a variability of NOI, your yield is going to change over time.
Got it. Now, let me ask you, how do people use your survey? Because it is incredibly detailed. So tell me, how do, apart from the fact that it's just fascinating to see all this stuff, how do people actually use it? How do they use it? As
I mentioned, it is CBRE's #1 download every year in research because it's so easy to use. It can compare apples to apples, market to market, and it's based upon real-time information, not just transaction data, because it's not average transaction data. It is based upon facts on the ground in the market that day. So like where we are today, like as we have this interview today on March the 10th, 2020, the market's in a period of distress. Have cap rates expanded? I have only gotten that question 30 times today. Okay. My short answer is no, they haven't. And the reason they haven't is because I look at this on a longer term basis. However, if somebody had to must sell today because their capital structure was exploding, you might see a higher cap rate for that asset. But the good news this time is we're not seeing exploding capital structures because most people were much more conservative in the way that they finance their assets. And there's so much equity capital that's so cheap in the market today that I don't see any cap rate expansion overall. I do see it in some asset classes. I'll be clear. I do see some cap rate expansion in hotels, and I see that in certain types of retail because I think they're going to be impacted from a sentiment standpoint longer than the next 6 months. The next 6 months are going to be choppy, but beyond that, I see all asset types going back to trend, but I see hotels and retail perhaps lagging a bit beyond that, but not all retail. Grocery anchored retail is just fine. Shopping centers are just fine, but it's really high street retail and malls that might have some problems for a longer period of time.
So the tumult that we're seeing in the market is a sudden event. But
yes,
you've been doing this long enough that you've seen cycles.
Yes.
And I do notice that your survey, and I don't normally have props, but that's a page of it here.
I have a prop. Here's my prop. Dunkin' Donuts, please sponsor me. You know how often I put your stuff on my screens? Sponsor me already. Go ahead, Adam.
I'm going to send this to them and see if they'll do that. I'll tell you. Let's see. Well, I probably wanted to. Did they lease or buy their properties? They probably lease, right?
They probably lease most of their assets.
Yeah, I knew a fellow called Fujita Den when I lived in Tokyo. Was running Universal Studios there, and he was Mr. McDonald's.
Okay.
Japan. He was opening, I want to say, 5 new stores a week. Okay. Unbelievable pace. And he owned all of them. He was one of the wealthiest guys in the world. So I was just wondering. I actually contacted him because he was a great resource for finding places to
Okay, well, here's one more product placement. White Castle Corporation. These guys were so nice to me when I went to Columbus, Ohio. I went there. They treated me like a king. They gave me this little gift certificate. So I like McDonald's, but I like the White Castle people more because if it was my last meal on earth, it'd be White Castle.
Right. All right. You're giving me all kinds of incredible marketing ideas. Every single guest going forward has to promote someone.
I promoted Dunkin' Donuts and White Castle, and damn it, I want something back from Dunkin' Donuts.
I'll see what I can do. You'd be surprised. Right. You know, I like play. I've got some tricks. Let's see if I can pull one off here. So what I was going to ask you, so I'm looking back over here. So this latest report goes all the way back, he said, tongue-in-cheek, to 2013. But we all know that the world didn't start in 2013. It actually restarted in around, what? Actually, it was probably around then, but the last downturn was 2007. So my question to you is that we're seeing some tumult now, and it's hard to imagine that it's going to affect cap rates today, right? But it certainly could have some impact going forwards because of exactly those expectations that you have, right? Growth expectations.
Yeah.
But how do cap rates vary? And I have another question to dovetail into this in a minute. How do cap rates vary through the life of the real estate cycle?
Sure. So historically, and you can see the charts on this, they go way up during a downturn, and then they creep back down, and they go back up again, and they porpoise right up and down, up and down, up and down. Now, one of the material changes that happened during the last cycle is a couple of things. Number one, when you got to the peak of prior cycles, you typically saw secondary market cap rates and primary market cap rates converge, okay? At the peak of this cycle, secondary market cap rates are still very wide of primary market cap rates, except in multifamily and industrial, where they're right on top of each other. In office and in retail and in hotels, still very wide. So I think, and I say this not to disparage secondary markets, but the market has shown more discipline this time in going into some of these markets that may not have the same growth expectations. They're not chasing yield. In fact, one of my clients uses the term a value trap. What is a value trap? You go into a market that has a high yield, it's like, oh, I'll get a great return. Well, what if NOI goes down? What if liquidity dries up? Well, that's what a value trap is. And so you're correct that historically you've seen this porpoising, and I'm using my hand as a prop here. But so change number one is that the convergence of secondary and primary has stayed wide in office, retail, and hotels, where typically was convergence. That's point A. Point B is the top of the chart now, I think, is permanently lower. So let's assume that if there are two basic concepts in economics that really drive modeling. One is reversion to the mean, and the other is the scariest four words in finance. This time is different, otherwise known as a secular shift, right? And so the reversion to the mean argument has consistently failed over the last 10 years because there has been a secular shift in markets like San Francisco and Boston and Austin, Texas. Why do I mention those three markets? Because if they go back to their historic means for cap rates and for rents, they're going to fall off the planet in terms of value. But that hasn't happened. And what is the secular shift that's occurred? Secular shift A is demographic, where we're seeing more young, talented people move to these markets. We're also seeing the large employers move to these markets. We're also seeing the industries in which they work, particularly tech and its subsidiaries like biotech, becoming such a big part of the market that they have outsized demand, which is stripping away demand from markets that had, quote, old school demand. There's new school demand and there's old school demand. New school demand is what we would call the TAMI industries, tech, information, media. Old school demand are the old school industries, which is law, accounting, finance, and government. And markets that have the disproportionate number of old school have not shown the same level of rent growth as those that have showed new school types of tenants. And when I say markets, I also mean sub-markets. So an example of that would be the difference between Midtown and Midtown South. Midtown South used to be this sleepy little backwater that had rents way below Midtown. Guess what? Rents in Midtown South are now higher than the rents in Midtown because of the tech explosion.
And how does cap rate, again, during a cycle, how does it correlate to IRR, to the internal rate of return?
Sure. So an internal rate of return is the net present value if the discount rate was zero. Right. So that is what the math of a IRR is, you know?
Right, which is how everybody speaks, right?
Right. Exactly. So that's the math of it all. Right. Okay. Now that you know the math, the IRR is really the unlevered IRR is, I think, a much better metric of value than is a cap rate. Because a cap rate is very static. It's based upon either 1 year forward or 1 year back or stabilized, right? I think that the unlevered IRR is a much better metric of value. It is used by most people in the finance field, certainly every lender, every sophisticated investor, because it talks about what is the returns going to be over your hold period, not just year zero.
Is the unlevered IRR the average cap rate over a period of investment?
If you were to take the unlevered IRR, let's say the unlevered IRR were 10. The answer is no, and I'll tell you why it's not. Because you also, in a cash flow stream, if you had an infinite cash flow stream, yes, it would be. But you don't have an infinite cash flow stream. What you have is an exit cap rate. And that exit cap rate has to be calculated based on something. And so you're getting that cash back. So ultimately, they're not exactly the same. Right. They're similar, but not exactly the same.
Got it. Okay. All right. So let's see. We've been talking for a long time. I know that I could, I've got a bunch more questions that I could ask you, but let me, if you don't mind, round up with 3 sign-off questions that I ask all of my guests. I would love to keep on going.
Sure.
But maybe we can pick it up another time. I am going to include a link to the survey.
Terrific. Thank you.
In the show notes. And I've also got a question for you off mic once we've finished, specifically about what you've got here. See if we can come up with some ideas. But I've got 3 questions that I always ask my guests at the end of every podcast. And the first one, actually, so let me ask this. What's been the hardest lesson you've learned in real estate? Or in your, like the hardest business lesson, right, that you've learned?
Well, my first day on the job, when I was a young lawyer in New York City, I found that there were 2 types of people. I was told that there were 2 types of successful people in the world: the cream of the crop and the jerks. And I've tried to run my whole career being the cream of the crop because I've run into too many jerks along the way.
It's a good start. Second question, what are your key daily habits for being successful in what you do?
Well, this is not necessarily the most positive answer, but it's true, which is I have this little inner fear of failure, and maybe I care too much about my clients. It sounds self-serving, but in the last 3 weeks, all I've done is work the phones, because I know if I'm a client, I'm scared, and I feel that same fear factor, not necessarily that I'm scared. So I would say that little bug inside you, which is really called drive. And I say this not because I'm awesome. I say this because I have this little fear factor in me. And so I also, in addition to being a real estate professional, I also teach public speaking. And when I teach public speaking, I say, look, I can teach you every technique under the sun. I can't teach drive. And that's what I'm really looking for in my professionals and my students, is that little inner bug of, I got to do more, I can do more, much more so than the tangible skill. I'll take somebody who is got more drive and a little bit less gray matter than somebody who's smarter that has less drive any day of the week.
My last question was going to be about giving advice to people listening, and particularly, I think, because of what's going on at the moment. And this is evergreen advice. But when there are black swan events, which can sometimes trigger major economic shifts, as perhaps we are seeing now, we don't know, but it's precisely that instills fear, right? Is that unknown. What advice do you give on all these calls? What is kind of the general high-level advice that you give to somebody dealing with tumult like we are now, or uncertainty?
Sure. So I could have tailored that question, because I wrote a blog a month ago, which I entitled Headline Risk Equals Opportunity. And I said that in the context of the presidential election, in the context of the Brexit. I did not say that in the context of the terrible things that are going on right now with the coronavirus, but I could have said the same thing about that too, because there's a real fear factor out there, and the number of bidders has gotten smaller, and there's people dying. It's a terrible thing that's happening out there. But if you look at it with a cool head, it will create opportunity for you as some of these bidding pools get smaller. So headline risk equals opportunity is my advice.
It's funny you should say that. I wasn't sure if that was something really to share. I've actually shared it with a couple of my clients who are concerned about expressing the same point of view for wanting, I don't know, just to not wanting to appear insensitive, which it isn't. It's pragmatic, but it's actually the exact advice that I gave to my 2 little boys sitting at the dinner table last night. Don't fear it, just understand it and look for opportunity, actually, not wanting to play down the seriousness. Spencer Levy, correct? I pronounced it right. Spencer, thank you so very much. What an enormous pleasure having you on the show. I really enjoyed it. Next time, perhaps with an awesome background behind you.
I'm going to get a more awesome background. I promise. I tell you, man, you are the king of this. I say this on the record. You have a beautiful looking podcast here, and I am going to do the best compliment I can. I'm going to beg, borrow, and steal it. Such a great idea.
Yes, so guaranteed I'm going to give it to you. I told you already, I'm going to share it with you by the end of the day. Yeah. And let's maybe, what we could do actually, why don't we should set up and do a follow-up in a couple of weeks.
We should. There was a Saturday Night Live skit with Billy Crystal called Fabio. His tagline was, looking good is better than feeling good. Well, maybe looking good is better than sounding good, because you look marvelous.
It's all fake. I mean, it's all, I'm totally computer animated.
Unfortunately, I'm all normal, which is why I don't look marvelous.
Spence, what a pleasure. Thanks so much.
Thank you so much, Adam.
Thank you. That was Spencer Levy, Chairman of America's Research and Senior Economic Advisor for CBRE. Interesting times we live in, and there's nothing better than an in-depth view of something that we take for granted. Cat rates, right, with Spencer today, especially as we try to fathom how this whole crisis will play out and attempt to make sense of it. Be sure to go to the podcast page for this episode at gowercrowd.com, where there is a slew of resources for you to help you through these troubled times. How to upgrade your home office, a guide for crisis communications, over 80% off our flagship investor acquisition system, online master course, and a bunch of other podcasts and articles, all there at gowercrowd.com. All right, that's it. Thanks for listening. And thank you, Spencer Levy, Chairman of America's Research and Senior Economic Advisor for CBRE, for your time with me today. That's all for this episode. I'll see you next time. And in the meantime, stay well. And for now, this is Dr. Adam Gower signing off.